seeing amongst other communities?
Yeah. So one of the things I notice is the in my in my daily interactions over here in the States, uh, people get really interested in this whole reflection network that we're doing, and we changed names um, before, so it used to be RPN, now we're RPN, but the concept of networking is very much familiar to them. Over here, they've got networks for everything you can think of, right? First off, out of school, there's like an alumni network that's school wide, and then you've got the more focused ones. At least for me, the interest group would be like business, finance, as granular as you want. And in the professional sense, ever since I've gotten out here, they've got one for just middle market banking across the nation. And primarily that would be ACG, I think it's Association for Corporate Growth. And they've got one chapter just for New York folks to get together. So, you name it, they have it. They've got buy side type networks, they've got sell side type networks for the bankers, for the agents, versus, the principal investors. You name it, they have it. But I think in Singapore, at least, based on what I know, which I may not be up to the minute on, we're not quite as developed in that area. We're
We're
not, we're
changing.
not quite.
That's our work in creating a rich community that allows us now to do everything that you just said. And our last event was on private credit. We had 5 great speakers. Unfortunately, you weren't in town, so we weren't able to have you on.
I know, my huge regret.
Yeah, but you are at the heart of it all. I think private credit has been more of a recent 5, 10 year kind of thing in Singapore or in APAC, but it's been around for ages. And yeah, I would love to hear more, especially about the um, probably better not name names, but PR fallout in the private credit.
Oh, I mean, it's headlines. It's none of this is secret, right? And you could name them all if you wanted to. Just to name a few, Ares comes to mind, KKR, BlackRock, even JP Morgan. Pretty much everybody with a private credit fund these days have some kind of headline that is undesirable. A lot of it is, at this point, it's just a cascade of withdrawal requests. And it's hard to pinpoint exactly what caused it. A lot of it is, I think, groupthink. You see one person going for the door, and you're a bit of FOMO, and you're like, well, what if I'm left holding the bag? And if you really were to try and trace this all the way back, when private credit started out, as the shadow banking, if you will, alternative asset class, it was really only for institutional investors, and the products were structured that way. The loans tended to be anywhere from more like 4, 5+ years type loans, and institutional investors knew that going in. They were okay with some volatility. What was most important to them was always preservation of capital, right? That's the reason why you choose this asset class over something like, say, public equities, where you get better returns with the S&P or the Dow or Nasdaq, but you don't have that type of certitude. And a lot of times, institutional investors had certain pockets of capital that simply had a different need than maximizing returns. For example, you have life insurance companies, right, that don't necessarily need to make a 3 times, 4 times, 5 times MOIC, but what they really need to know is that preservation of capital is there. And then
And this,
sometime after,
yeah,
I'm sorry.
it's very good that you mentioned this because I think a lot of the investor classes in the APAC region they tend to be family offices that have a very traditional business and who are looking to diversify away from their traditional business, which may be in the sunsetting mode. And oftentimes we see them, start moving into things like equities, like pre-IPO type businesses. Whereas from like a professional perspective, you're completely correct that, maybe like a more senior debt kind of product or even a mezz debt but secured could be more interesting, like where the principal, there is a structure to preserve the principal as opposed to chasing like multiples and returns. Yeah.
So, so what you're saying is not unique to Southeast Asia. In fact, sometime maybe a year or two after COVID's flare up, so call it 2021, 22 was when the private credit craze really started. One of the big trends was there simply wasn't enough money to fill the coffers of these new funds, new private credit funds that were popping up like a weed. Everybody who set up a fund
Wait,
claimed to be special
like a fundraise
and
with.
to fundraise, yeah, fundraise for
Okay.
private credit. And so, institutional capital couldn't keep up with that. I mean, they were allocating more, but they couldn't keep up with that demand. And so one of the things that happened is that private credit fund managers decided that they would go chase retail money.
Mm,
And I think oftentimes that is a signal that you're at the peak when retail money starts piling in. And retail is a very broad term. You have accredited investors who know what they're doing, and I personally know a bunch of these types of people who are maybe ex-finance or people who have experience in the space trying to invest their own money or maybe invest on behalf of family, friends. But they know what they're doing and they know what they're signing up for. And if they're trying to get invested, get some exposure to private credit, they know that this is an illiquid asset class. That's totally fine. In fact, I'm all for that. The market the democratization of you know these types of investments, whether it is things like SpaceX pre-IPO, where you could really benefit from a huge bump in the price, or things like private credit, which your typical average investor is not able to access. The problem comes when this type of product is being marketed to people who do not know what this asset class is. And all they're seeing is the marketing speak of like, hey, you're getting, here is a 20% IRR, 22% IRR, right? So meaning you get a 22% return. It just gets translated very loosely like that. Um, and then they try and compare that to equities and they say, oh, well, you know what? That looks almost comparable or perhaps even better than what the S&P is doing on an annual basis. So why not? And, it seems like a too good to pass up deal. And newsflash, if it's too good to pass up, too good to be true, it is too good to be true. Because that is not what this asset class is about. People who come into the private credit asset class without understanding fundamentally what they're getting into, without understanding that this is an illiquid asset class, meaning you don't get to take your money out. Because if you did, then you'd have basically a run in the bank. That's why most of these private credit funds have a little known, but up until recently, when it was in the news, up until recently, people didn't know that there is as a general rule, about 5% cap quarterly or whatever the redemption window is. Right, so a lot of I would say retail investors come in not knowing that. They only see the flashy headlines. They think great return, hot asset class. I want to get in on the action because this is what everybody's talking. Anybody who is anybody is talking about right
would
now,
you
and,
say that
and that's a problem.
would you say that it's maybe, the introduction of semi-liquid private credit structures that have caused some mismatch in investor expectations rather than, going out and letting people know long-term close-end fund?
No, no. First of all, yes, maybe these are a little bit of small innovations along the way, but I don't see anything wrong with having an open-ended evergreen fund. They certainly have. They serve their niches. They serve their purpose. there is a place for them, as in your invest in any investor's toolkit. As long as you know what you're doing, as long as you're able to match up, cash that you're able to leave in there for a good 5 to 10 years, not a problem. And there is a time and place for these types of funds when we think about what is being invested in as well. Oftentimes companies don't just pay off at the end of the 5 year term or whatever when one of these, private credit loans come to you. Oftentimes what happens is it gets rolled. It might be refinanced by a different fund. So, you know, somebody else comes in, maybe at a better rate, since the company presumably would have grown at that point, is a better credit, more credit worthy. Or sometimes the company is doing poorly and ends up being refinanced at a higher rate because that's the best they can do at that time. But whatever it is, oftentimes, you don't necessarily just get your principal back. So it can make sense to have an evergreen fund, especially in cases where you actually like the cash flow profile of the company and you would like to remain invested. In today's environment, particularly where there is a dearth of good assets to invest in, there is a dearth of what we call new paper, right? For a variety of reasons, M&A activity isn't quite what um, it was, I think, a couple of years ago. So with less M&A activity, there is less paper being issued, less high quality paper being issued, which is more important than just the volume of paper being issued. So a lot of times private credit fund managers may really want to stay invested in the assets that they already have. They don't want to give it up, especially if it's a good asset that is, producing solid returns, pays up the interest regularly, may not be able to pony up the principal at the end of the 5 year term, but there's nothing wrong with that. Most companies don't plan to pay up the principal anyways. They just roll the debt. That is very common strategy.
So are there any other kind of interesting structures you're seeing on the horizon you're working on that or that are, we like fundamental puzzles. We like bringing new products into the region as well. So anything you're seeing on the horizon?
Incrementally, I'd say, you get your covenants that are flexible enough, such that you get more pick, especially in this current, and I should say, pick being payment in kind. So you get companies that maybe wish to, for whatever reason, either are under pressure from a cash flow perspective in the early years, or perhaps they just would like to preserve cash for growth, and private credit can afford to be very flexible around that, right? So those are incremental. It's nothing new, and you tend to have
Are you
all
seeing
these
that more?
structures in place.
Are you seeing that more and like amongst kind of businesses that have their main markets in the Americas or yeah.
I would say in general, yes. At this current point in time, regardless of whether you actually need that type of headroom or not, the prudent thing to do is to try and build in some of that headroom. Obviously, it doesn't, it's not free. This type of optionality, you pay for it in the form of higher yields, or perhaps there's a higher OID involved, origination, which is another way of the lender charging fees. So one way or another, yeah, pay for it. The way private credit terms look like, it's a web of interconnected things. You get relief in one area, you probably get pushback in another area.
Flexibility.
All in all, you're paying for it somehow. Um, but that's the allure of this asset class for issuers, for companies, right? Because it is, in the true sense of the word, it is bespoke. Unlike if you go out and try to do a bond offering, well, that's a one size fits all, like covenants or no covenants, whatever it may be. Um, and the moment you default, you default. In private credit land, a lot of times, if you start getting close to defaulting, you work with your creditor and you try to avoid a bankruptcy, which actually can cut both ways. It can make it kind of hard to tell when things aren't going so well. When you look at a portfolio, because you don't see the bankruptcies, you don't see the defaults, but they've been restructured. And it takes someone who is in the flow to know, right? And not even necessarily tracking each paper, but kind of being in the flow and in the market deal flow, knowing that the number of restructurings is going up. And even for someone like myself as an agent, who's in the flow daily talking to counterparties, I may not even see some of these because they get negotiated directly with the lender with no third party involved, which is oftentimes the preferred route because when you have a problem, you don't want to broadcast it, right? You would like to take care of it quietly. So private credit it cuts both ways. It's a difficult, I would say it's a difficult asset class to understand, and even when you do understand it, it's difficult to monitor. You truly need somebody who spends a lot of time in it, focuses on it, and that's why at the beginning, going back to the beginning, I said this is really not an asset class for the casual retail investor, right? The retired, maybe 65-year-old um, retiree who's just looking to get a better return. Probably not the right audience.
Absolutely agree. Yeah. I think that's about it.
It's a very difficult space to understand, even for people who live in it, right? Every day you learn something new, and um, one of the things that you realize is uh, the the market is such that there are many. I would say it's a very fragmented market. So even my experience and what I'm seeing may be completely different than what some other banker at another firm that's maybe a rival to mine, but doing really the same thing, perhaps in a different state, different geography, or slightly different industry vertical focus. What he's seeing could be completely different than what I'm seeing. So even for industry experts like myself, we have to get together regularly with fellow industry experts and talk. Just, hey, what are you
I
seeing in the market?
A huge opportunity because if you're seeing that there's not enough good paper out there, I mean, I don't know what the penetration rate is in the APAC markets, but certainly there are opportunities here. And we could use a lot of the more kind of structured financing capabilities, as well as investor access, depending on, what the investor class that you're able to
One
reach.
of the one of the biggest things I can tell you I see on a daily basis, but exacerbated, especially true today in light of headlines and lenders, private credit lenders are pulling back a, a bit indiscriminately, if you will. Mostly risk off posture. A lot of lenders are retreating. What one might call a flight to safety, right? They're retreating to verticals that they know best. Maybe verticals that
Sound like
they're found. Yeah, well, it's a very natural human response, right? In the face of the on again, off again war in Iran, in the face of the 4+ years war going on with Russia and Ukraine, you don't know what the price of oil is anymore. You wake up every day, it's something different. A lot of lenders faced with this and faced with a big thing in the US is the Fed, right? And they recently had a new Fed chair. Kevin Warsh came in. The market's still trying to figure out what this guy is all about. Is he really going to cut rates like he sort of talked about doing before he got got the post. Now market is saying probably not. He probably is going to hike rates instead based on what the futures markets are saying. By the end of the year, probably get one or two 25 basis point hikes. With all this uncertainty, whether it's global geopolitics or just at home, what our central bank is going to do in the US, lenders are saying, well, I don't really know. There's a lot of uncertainty. I don't know what the landscape's going to look like. And then it's very natural human response in that type of situation to say, I'm going to withdraw and I'm going to do what I think I do best. I'm going to withdraw and do only the industry verticals, for example, that traditionally I've done a bunch of deals in, and so I think I know that space better. And that is leaving pockets of the market, especially in the middle market, right, which is very fragmented market, leaving large pockets where issuers, where companies are not able to find capital at reasonable risk reward, on the reasonable risk reward spectrum. And maybe it's coming in the form of far too expensive capital for the risk profile of that issuing company, or in some extreme cases, they're just not finding capital to be accessible. So I would say there definitely is a place for Southeast Asia, APAC investors to look into middle market companies in the US and figure out what are the industries that they are comfortable with, what are the industries, and really, which are the agents, the bankers that they're comfortable with working with, who can tailor the product, tailor the terms uh, for an investor that looks, I would say, quite different than your typical US private credit investor. That fund manager probably has LPs who are, you know, partly institutions like pension funds, maybe some high net worth family offices, private private wealth type LPs, and in Asia, that landscape might look quite different.
Yeah.
So knowing to connect the right investor to the right deal is
Yeah, I think
pretty
that's right.
important.
Yeah, that's right. I mean, it goes both ways, right? Either APAC like issuers or issuers in the US. There's gonna be a need, for an opportunity both ways to discuss it. And yeah, that could well be the next topic of our kind of regional global get together. Yeah,
Yeah, I mean, it certainly it would be quite the undertaking, but with something of that scale, obviously the reward would be quite attractive as well.
awesome. Thank you for your time, Andrew. We'll see you back soon.
Well, thank you for having me.